Let's start with the big picture. The world is not ending, but it is changing, and that difference matters. For decades, we lived in a system that felt stable. Money was easy, trade was smooth, inflation was low. Governments could borrow without much consequence, and central banks always seemed to have a solution. That world is slowly fading. Not overnight, not dramatically, but steadily. Today, almost every major country is dealing with the same problems at the same time: high debt, political tension, rising costs, and slower growth. When these pressures happen together, the system becomes fragile. Gold doesn't react to headlines. Gold reacts to fragility. When people trust the system, they don't need gold. They invest in businesses, bonds, and growth. But when trust starts weakening, even slightly, behavior changes. People stop asking, "How much can I make?" They start asking, "How much can I lose?" That shift in mindset is everything. Right now, trust is being tested from many directions. Governments argue more, trade relationships are tense, wars and conflicts don't fully end, they just pause. Rules change more often, and policies feel less predictable. This doesn't cause panic, it causes caution. And cautious systems behave differently. Money becomes defensive, capital looks for safety, long-term promises feel less attractive, assets that depend on stability lose favor. Gold benefits from this environment because it doesn't depend on anyone's promise. It doesn't require growth. It doesn't need confidence in leaders or institutions. It simply exists. That's why gold tends to rise during long periods of uncertainty, not just during sudden crises. It performs best when the system feels uncomfortable but not yet broken. We are in that phase now. The pressure is building slowly, and history shows that when pressure builds over time, people eventually move toward assets that feel permanent. Gold is one of those assets. But to understand why this pressure keeps increasing, we need to look at where it starts. It starts with geopolitics.
Most people think geopolitics only matters when a war begins. That's not true. Geopolitics matters long before the first shot is fired. Markets don't wait for events. They react to risk. When relationships between powerful countries become unstable, uncertainty rises. And uncertainty changes how governments, businesses, and investors behave. Take global conflicts and tensions today. Many of them don't fully explode, but they never fully resolve either. They stay in the background, constantly reminding the world that things could get worse. This creates hesitation. Companies delay investments. Countries increase military and energy spending. Trade partners become cautious. Long-term planning becomes harder. That hesitation slows growth. And when growth slows, debt becomes heavier. Governments already carrying massive debt loads suddenly feel more pressure. That pressure eventually reaches central banks. This is how geopolitics enters the financial system, not through panic, through friction. Another important point: geopolitics today is more complex than before. Power is no longer concentrated in one place. More countries are asserting themselves. Alliances are less predictable. Communication breaks down more easily. This makes the global system harder to manage. When rules are unclear, people prefer assets that don't rely on rules. Gold fits that description perfectly. It doesn't depend on treaties. It doesn't depend on cooperation. It doesn't depend on trust between nations. That's why geopolitical tension, even without full-scale war, supports gold over time. But geopolitics alone isn't enough. It needs a pathway to affect daily life.
Energy is how global tension becomes personal. Oil and energy prices affect everything. Transportation, food, manufacturing, heating, electricity, all of it depends on energy. When energy prices rise, inflation follows. Not slowly, not gently, it moves fast. Even the fear of supply disruption can raise prices. Markets don't need shortages, they just need risk. When energy becomes expensive, businesses pass costs to consumers. Households feel it at gas stations and grocery stores. Inflation spreads across the economy. This creates a serious problem. Inflation reduces purchasing power. It makes money worth less. And when inflation persists, people lose confidence in savings. That's when gold starts to shine. Gold has no operating costs. It doesn't require energy to produce returns. It simply holds value while currencies lose purchasing power. Historically, energy shocks and inflation have been strong drivers of gold prices, not because gold changes, but because money weakens. And this matters even more today because economies are already stretched. High energy prices don't just raise inflation, they slow growth. That combination is dangerous. It puts central banks in a difficult position.
Central banks usually fight inflation by raising interest rates. Higher rates slow spending and cool prices. But this time is different. Debt levels are far higher than in past cycles. Governments, companies, and households all rely on cheap borrowing. When rates rise, debt becomes harder to service. So central banks face a trade-off. Raise rates too much, and they risk financial stress. Lower rates too soon, and inflation returns. This creates instability, and instability hurts confidence. The most important concept here is real returns. If inflation is higher than the interest you earn on savings, you are losing money, even if your account balance grows. When people realize this, behavior changes. They stop trusting cash and bonds to protect value. They look for alternatives. Gold thrives in this environment because it doesn't promise returns. It preserves purchasing power over long periods. Central banks understand this better than anyone. That's why many of them are increasing gold reserves, not because they expect collapse, but because they see limitations in their tools. Gold becomes insurance.
Currencies are powerful tools. They allow governments to trade, borrow, and influence the global system. But currencies also depend on trust. When countries see currencies being used as political weapons, they rethink their exposure. They don't abandon the system, but they diversify. Gold benefits from this shift. Unlike currencies, gold doesn't belong to any country. It can't be frozen. It can't be printed. It doesn't rely on financial networks. This makes it attractive as a reserve asset. Central banks are not trying to replace currencies with gold. They are trying to reduce risk. Gold provides balance. This steady, long-term demand supports prices even without retail excitement. Silver is different from gold. Gold is stability. Silver is sensitivity. Silver has monetary value, but it's also heavily used in industry. Solar panels, electronics, and technology consume silver permanently. That means supply is tighter. When inflation rises and gold moves first, silver often lags. But when confidence shifts strongly, silver tends to accelerate. This makes silver more volatile. It can fall harder, but it can also rise faster. Historically, silver performs best later in inflationary cycles, when investors search for alternatives and industrial demand remains strong. That's why silver is often seen as leveraged exposure to the same forces driving gold. Not safer, but potentially more powerful.